It's a never-ending debate. What investment is best for wealth building? Or more specifically, what asset class is the best asset class to invest your money in? Is it the well-known large cap companies? Big boys like Apple, Amazon, and Google? Or is it the exciting up-and-coming small cap companies? Or how about international companies from emerging markets like India and China? With so many options to choose from, where is the best place to invest our money for wealth building? So to tackle that age-old question, in today's video, we're going to review the 9 most popular asset classes. More specifically, how they performed the past 20 years, and if they would be a good choice as our vehicle for wealth building. And hi, if you're new to China, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. To assist with our ranking, I'm going to be referencing the Callan Periodic Table Investment Returns, modeled after the famous Periodic Table of Elements, and the industry standard market proxy for each asset class. We're going to look specifically at the past 20-year returns, from 2003 to 2022 for this ranking. I know what you're thinking. Past returns are not a good indicator for future returns, and I'll probably mention that several times throughout this video as well, but it does provide a good starting framework for our analysis. Alright, with that said, let's get right into it. To kick us off, the asset class with the highest average return in the past 20 years. Emerging market with close to 13% in return. This asset class is represented by the MSCI Emerging Markets Index, an index that is designed to measure the performance of equity markets in 25 emerging countries around the world. Think of big developing countries like China, India, and Brazil. And this market represents about 1,400 companies from these emerging countries. Ever heard of Taiwan Semiconductor Manufacturing? Or Tencent Holdings? They're major power players in Taiwan and China that also indirectly services a good chunk of the world. So what does this mean? With close to 13% returns the past 20 years, should I park all my money in emerging markets? Well, not so fast. Let's unpeel the chart to understand this 13% return. Though the average annual return is impressive, there is quite a bit of volatility between the years. For example, the emerging markets had some amazing returns in 2009 and 2003, with 79% and 56% returns respectively. Pretty ridiculous returns, almost like voodoo magic. If you put money in emerging markets in the late 2008, your balance would have almost doubled. But of course, that only tells one side of the story. When looking at only the high returns, it's tempting to park more of our money there. I mean, where else could you get close to 80% return on your money? But just like a lot of things in life, if there are highs, there are likely lows. In 2008, before the amazing run that the emerging markets had in 2009, the market fell by more than 50%. The bottom line is that while emerging markets can be a good place to eke out some decent returns, you need a strong stomach to ride out these ups and downs. However, if you like the risk and want to get more exposure to emerging markets, the Vanguard Emerging Market Stock Index Fund, aka VEMAX, is a great option. If you want the ETF version, you can go with the Vanguard FTSE Emerging Markets ETF, aka VWO. They both have great expense ratio of 0.14% and 0.08% respectively. VEMAX follows the FTSE Emerging Markets Index and holds close to 6,000 emerging market companies, providing a slightly broader exposure than what the Callan table tracks. Asset class with the second highest average return in the past 20 years. Large cap equity with 11.3% in returns. This asset class is represented by the S&P 500 index, the Standard & Poor's 500 index, an unmanaged benchmark that represents the 500 largest publicly traded companies in the United States. Think of familiar big boys such as Amazon, Apple, Google, and Microsoft. And smaller in market cap, but still fairly big companies like Kroger, Dollar Tree, and Delta Airlines. Each company's representation in the index is proportional to its market value, so bigger is market cap, bigger is representation in the S&P 500, and smaller is market cap, smaller is representation. And it's good to know that the S&P 500 is probably one of the most widely followed equity index in the world. It's most often used as a benchmark for health and performance of the broader economy. Let's take a look at the year-by-year performance of the S&P 500 in the past 20 years. For the most part, the returns are positive, sometimes going as high as 32% in 2013 and 32% in 2019. And it only had 3 negative years, 2008, 2018, and 2022. An 11% return over the past 20 years is pretty consistent with the broader trend. The average annualized return since adopting the 500 stocks into the index in 1957 through 2022, a period of 65 years, is slightly over 10%. And from my personal perspective, investing in a broad market index fund that follows the index like the S&P 500 is one of the most effective ways to grow your wealth in the long run. If you're interested, the Vanguard 500 Index Fund, aka VFIAX, is my fund of choice. If you want the ETF version, there's the Vanguard S&P 500 ETF, aka VOO. Both have great expense ratio at 0.04% and 0.03% respectively. A hard to beat price in the mutual fund industry. Alright, moving on. Asset class with the third highest average return in the past 20 years. Small cap with 11.2% in returns. This asset class is represented by the Russell 2000 index, an index that measures the performance of small cap US stocks. Basically the 2,000 smallest stocks in the US stock market. For those of you hearing about this concept of small cap, and I briefly alluded to earlier large cap for the first time, let me explain for clarification. Broadly speaking, in the world of finance, companies are categorized based on their size, most often simply called large cap, mid cap, or small cap. Large cap companies are companies valued more than $10 billion. Think of big boys like Apple, Amazon, and Microsoft. Mid cap companies are companies with market capitalization generally between $2 billion and $10 billion. Some companies classified as mid cap include First Republic Bank and Devon Energy Corp. You might have heard of them if they're local to you. And small cap companies are companies generally valued between $300 million and $2 billion. You've probably not heard of many of these companies unless you've been following them for a particular reason. Most often, different sized companies operate differently and therefore different future performance. A big company might not have the aggressive growth trajectory like a small up-and-coming startup, but are considered more stable. Mid-cap companies might be more stable than small cap, but provide stronger growth opportunities compared to large cap companies. And small cap companies, though may experience more volatility and pose higher risk to investors, have the potential for high rates of growth. Let's see if this is the case for the past 20 years. Here you see the small cap companies. A great deal of volatility between years. Are the swings much bigger than large cap companies? Let's take a look. When we overlay the S&P 500 graph, highlighted here in orange, over the small cap performance, we do notice there are years where swings are a bit more extreme than large cap companies. 2003, 2010, and 2013. But what's most interesting is there are years when the S&P 500 outperformed the small cap. 2017, 2019, and 2021. In 2021, the S&P 500 had a return of 29%, whereas small cap had a return of 15%. Pretty good, but half of what the S&P 500 returned. The bottom line is small cap has a potential for outperforming large cap, but that is hard to predict given the trend the past 20 years. And with so many of the biggest companies being fast-moving tech companies, you can never tell if a small cap startup can do better than Apple, Tesla, or Google. Nonetheless, if you want to invest specifically in small cap companies, my recommendation is the Vanguard Small Cap Index Fund, VSMAX. If you want the ETF version, Vanguard Small Cap ETF, aka VB. And like other Vanguard funds, they both have great expense ratio at 0.05%. The fund represents close to 1,500 small cap companies across sectors like consumer discretionary, energy, and healthcare. A quick interruption, for a limited time, I'll be opening up my calendar for one-to-one money coaching sessions, a time where you can connect with me directly, as well as ask me any money questions you might have. Especially helpful if these talks about investing and returns confuse you. The money journey is hard in itself, and sometimes you just want to get some unbiased feedback without judgment. If you think this could be a value add to your financial journey, please go to my website to learn more. I'll also have a link in the description below. Alright, with that said, let's get back to the video. Asset class with the 4th highest average return in the past 20 years. Real estate with close to 10% in return. This asset class is represented by the FTSE EPRA Nareit Developed REIT Index, an index designed to measure the stock performance of companies engaged in specific real estate activities in North American, European, and Asian real estate markets. If I can be blunt, real estate investing sounds sexy. We've all heard of big real estate conferences and classes that could make you rich beyond your wildest dreams. But how many of us have ever heard of index fund investing conferences that could make you rich in 10 years? Maybe I should start one. If you're a fan of real estate investing, but don't want to do the legwork of actually buying and managing properties, REITs could be a great option. Real Estate Investment Trust. A REIT is a company that owns, operates, and finances income-generating real estate. They're essentially modeled after mutual funds. So buying a REIT is similar to buying an index fund. Index funds allow us to buy publicly traded companies without buying individual stocks. Similarly, REITs allow us to tap into the real estate market without having to actually buy, manage, and finance any properties ourselves. Let's take a look at its performance the past 20 years. Not surprisingly, it had its worst year in 2008 with a loss of 48%. However, since then, it's recovered quite well and it had some decent returns in 2012 with 28% in returns, 2019 with 22%, and most recently, 2021 with 26% in returns. Also, when I overlay the S&P 500 performance over real estate, you see here several points in time where real estate outperformed the large cap companies, 2006 and 2009 most notably, making the argument that its addition may offer some diversification to a standard equities portfolio. I wouldn't make this a core holding in your investment portfolio, but it's a good added diversity to your overall wealth. So if you like the idea of real estate and want to add some to your investment portfolio as an added diversification, consider the Vanguard Real Estate Index Fund, also known as VGSLX. If you want the ETF version, Vanguard Real Estate ETF, aka VNQ. They both have pretty good expense ratio of 0.05%. The fund represents 165 real estate companies that represent all different types of property investments in the real estate industry. Properties such as office buildings, hotels, and even residential homes. Asset class with the 5th highest average return in the past 20 years. Developed international market with 8.5% in return. This asset class is represented by the MSCI World excluding USA, an index that is designed to measure the performance of large and mid-cap equities in developed markets in Europe, the Middle East, the Pacific region, and Canada. Think of countries like Japan, United Kingdom, and France, and companies like Nestle, ASML Holding, and Toyota. Some prefer the developed international markets over the developing international markets I referred to earlier because developed nations have more advanced economies, better developed infrastructure, and more mature capital markets, an environment for more stable growth. Emerging markets, on the other hand, while showing higher economic growth, tend to experience higher levels of political and economic instability, thus greater volatility in its returns. Let's take a look at its performance over the past 20 years. When we look at just the developed international market, it looks pretty similar to other graphs we saw earlier. Major dip during the financial crisis and recovery since. Now, when we overlay the developing market over the developed market, you see how the swings of the developing markets are greater, much higher in 2009 and 2017, greater dips in 2015 and 2022, thus accounting for developing markets, as mentioned earlier, having an average return of 13%, while the developed markets only returned an average of 8.5%. Still pretty good, but not spectacular. If you like investing internationally, but don't want the ulcer that comes with developing markets, investing in developed markets could be a good option. If you're interested in investing in developed markets excluding the USA, consider the Vanguard Developed Markets Index, aka VTMGX. If you want the ETF version, Vanguard FTSE Developed Market ETF, aka VEA. Expense ratio of 0.07% and 0.05% respectively. Again, prices hard to beat. It represents approximately 4,000 international companies from developed nations. Companies such as Nestle, ASML, and Samsung. Asset class with 6th highest average return in the past 20 years. High yield bonds with 8.4% in return. This asset class is represented by the Bloomberg High Yield Bond Index. This index is designed to measure the performance of publicly issued, US dollar denominated, high yield corporate bonds with above average liquidity. High yield bonds are generally rated below investment grade and are sometimes referred to as junk bonds. Junk because these bonds are considered riskier than investment grade bonds. Investment grade bonds are bonds issued by companies with high credit ratings. However, high yield bonds have a higher probability of issuers defaulting on its debt obligations. But some investors like high yield bonds because they offer the potential for higher returns, especially during periods of economic growth and low interest rates. However, if you want my personal opinion, I wouldn't recommend people investing in high yield bonds. For one, when we look at the performance for the past 20 years, similar to the equities market, there's a lot of volatility. And volatility in the equities market is understandable. However, the question we need to ask is, what are we trying to achieve by also having bonds that have such volatility? When we overlay the S&P 500 performance over the high yield bonds performance, there are just too many similarities to consider high yield bonds as a good addition to our portfolio. In my humble opinion, it just doesn't add any additional diversity besides greater risk. The purpose of holding bonds in your portfolio is really to help smooth out any bumpy rides in the stock market. Here, it's doing nothing of that sort except making the ride even bumpier. So if you want bonds in your portfolio to actually help smooth out your investment ride, let's jump into the next asset. Asset class with 7th highest average return in the past 20 years. US bonds with 3% in return. This asset class is represented by the Bloomberg US Aggregate Bond Index, an index that includes US government, corporate, and mortgage-backed securities with maturities of at least 1 year. Yes, I know what you're thinking. 3% return? Why would I want that? Let me explain. Bonds' purpose in your portfolio, as I mentioned earlier, is to really help smooth out any bumpy rides in the stock market. And the general rule of thumb is that you want to start adding them to your portfolio as you get closer to retirement age. Take a look at the past 20-year performance of the US bond market. Very flat, very boring. But that is exactly what you want. What having bonds in your portfolio will do for you is that during times of market crash, where your stock investment can dip by 20 to 30%, your bond investments will hold steady. Just take a look at the chart when I overlay S&P 500 over US bonds. In 2008, when the large cap market crashed by 37%, the US bond market held steady at 5%. Yes, you aren't getting all the returns that the stock market is getting, but that is the whole point of having bonds. Thus, if you're nearing retirement and want to tap into your nest egg soon, you want bonds in your portfolio. You don't want to be caught in a situation where you need to pull your money from the stock market when it's 20 to 30% down, or worse, 37% like the 2008 crisis. The best US bond fund I would recommend is the Vanguard Total Bond Market Index Fund, aka VBTLX. If you want the ETF version, Vanguard Bond Market ETF, aka BND. Expense ratios are 0.05% and 0.03% respectively. It holds over 10,000 varying bonds such as US Treasuries and mortgage-backed securities of all maturities, and all with excellent credit ratings, most US government or AAA ratings, the complete opposite of high-yield bonds. With this one single bond fund, you get a broad exposure to the US investment-grade bond market. Greater the broad exposure to a diverse set of bonds, lesser the risk. Asset class with 8th highest average return in the past 20 years. Global bond market, excluding the US, with 2.7% in return. This asset class is represented by the Bloomberg Global Aggregate excluding US Bond Index, an unmanaged index that is composed of several other Bloomberg indexes that measure the fixed income performance of regions around the world, excluding the US. Essentially, you like bonds so much that you want to hold bonds from other countries other than the US. You want a piece of the Australian government bond, a slice of the African Development Bank, or a cut of Bank of Nova Scotia. The global bond market, excluding the US, can do that for you. And similar to the US bond market, the year-to-year volatility is pretty low. Though when we overlay the US bond market over it, it could be considered a bit riskier. As you can see in 2003, 2005, 2017, and most recently 2022, the returns are greater in degree compared to US bond market. Understandable given that a good chunk of the US bond index is made up of very stable US government bonds. If you want to invest in this index, the Vanguard Total International Bond Index Fund, aka VTABX, is a good option. If you want the ETF version, the Vanguard Total International Bond ETF, aka BNDX. The expense ratios are 0.11% and 0.07% respectively. This fund represents over 7,000 bonds from all over the world, representing countries like the Netherlands, Portugal, and South Korea. And finally, last but not the least, asset class with the 9th highest average return in the past 20 years, cash with slightly over 1% in return. This asset class is represented by the 90-day Treasury bill, or better known as T-bill. T-bill is a short-term US government debt obligation backed by the Treasury Department and therefore widely regarded as very low risk and secure investment. It's not a surprise that cash is the asset class with the lowest return. Cash in your checking or your savings account will not make much in return, but also not decline like the stock market. Of course, keeping all your money in cash is not the smartest idea given inflation, and you aren't giving it any chance to appreciate. Alright, with all that said, you might be asking at this point, Tay, what's the point? The numbers and charts are interesting, but what should I do with this information? Interesting dinner table talk, but not sure what my next step should be. Well, let me start out by stating what you shouldn't do. You shouldn't try to use this data to predict what asset class is the best and where you should park all your money in. As the table in the data has shown, there is uncertainty inherent in all the markets. A market that did fabulous one year quickly falls to last place the following year, vice versa. Past performance does not predict future performance. It's pretty much the World Cup every 4 years, right? Who's going to win 2026 World Cup? Who knows? The purpose of Callan periodic table investment returns is to make the case for diversification across asset classes, stocks and bonds, capitalization, large versus small cap, and equities market, US versus global. Therefore, what do I like to do personally? I try investing in them all through a very simple two-fund strategy. The Vanguard Total Stock Market Index Fund, VTSAX, and the Vanguard Total Bond Market Index Fund, VBTLX. And when I'm feeling a bit dangerous, a little bit of international flavor through the Vanguard Total International Stock Index Fund, aka VTIAX. And of course, cash to give me that extra level of emotional comfort. It's not sexy, and it doesn't make for much dinner table conversation, but it gets the job done. If you'd like to learn more about this super simple but effective two-fund strategy, please check out my video here. Thank you guys for watching. Until next time, all the best.